Okay, well, hello and welcome everyone, and thank you for joining me today, this evening on this webinar. This is our Balanced Wealth Planning webinar on inheritance tax planning, considering the here, now and the beyond. In this webinar, we're going to be looking at the delicate topic of estate planning and inheritance tax matters during these difficult and challenging times. The information is correct as of today's date, 27th August 2020, and is applicable in English law. So if you're based in Scotland, then some aspects could be different for you. As more information and relevance guidance becomes available through things like changes in legislation for inheritance tax, we'll communicate this usually via our newsletter sent by email or a blog on our website, or perhaps even another webinar. So if you haven't already done so, please register your details via our website, balancewealth.uk, so you can be kept up to date. This is part of our regular series of webinars that we're hosting. We've previously covered topics such as financial planning and divorce, redundancy, selling a business, ethical investing, and retirement planning. And recordings for previous webinars are available too. This webinar is also being recorded, so it will be available upon request. And in terms of housekeeping, you should all be muted so we can help keep background distractions and noise to a minimum. And please bear with me for any technical gremlins. We're all working remotely and doing these things sort of remotely, so things like internet, and there may be lags with audio and video and so on. So just let me know if there's any issues. The sessions are interactive, so please do use the Q&A chat function, which you should find on your screen. And if you have any specific questions about your own circumstances, then it may be more appropriate to arrange to speak with your financial advisor or solicitor. If you don't have one yet, then you can arrange an initial meeting with us, which you can also do via our website or by contacting us via phone or email. And we do offer everyone an initial meeting at no cost, and there'll be further details given out at the end. So your speakers today will be myself, Rupesh Katecha. I'm a financial planner. I've been working in financial services for almost 20 years. Started working as a financial advisor in 2009. Most of the clients that I look after tend to be those either coming up to retirement or already retired, and those that have tax planning concerns such as inheritance tax. I carry out holistic financial planning, which means I look at all areas of finance with a focus on helping people achieve their goals. We've also invited a special guest today, Marie Cooper, who is a Managing Associate Solicitor at Freeths in Nottingham. Marie has been a qualified solicitor since 2012 and has 14 years of experience working within legal practice. She covers a mix of areas, including wills, estate and trust administration, powers of attorney, and has experience drafting wills for those who have assets abroad. And Marie has experience in providing succession advice to business owners and administering estates where claims for business relief are required. Financial planning and inheritance tax planning go hand in hand with legal services, so it's important to consider the two areas holistically rather than two separate parts. So the aim of the webinar is to provide you some guidance and comfort at what is an uncertain time. We all often get caught up in our day-to-day lives and often take it for granted that we'll eventually get to the more challenging items on our to-do list. And when we speak to our clients during our regular reviews, we often find the most common items that are still outstanding on the to-do list that often get pushed back are things like sorting out a will or power of attorney or looking at estate planning. Now, the pandemic may have brought these items into focus and given you some time to think about some of the what-if scenarios. You may be unsure if you have an IHT liability of your own and how much might be lost to tax. You might be unsure if there'll be enough funds readily available for spouses or children to access, and even want to know where you can go for help and what you can do. And you may not even be aware that all of your assets are frozen when you pass away. So there are some things to consider there. So we'll be looking at all of these areas, and tackling them sort of one by one as we go along. Now, inheritance tax, well, what is it? It's firstly, it's not normally considered a donation to HM Revenue and Customs, unless, of course, that's your intention. But simply put, it's a tax on the estate of someone who has died. Estate means the property, money, and possessions, and the tax liability can be quite significant, as we'll see shortly in some examples. Now, there's normally no IHT to pay if the value of your estate is below a certain threshold, and that threshold is 325,000, which is known as the nil rate band. Or if you leave everything above this threshold to your spouse, civil partner, charity, or community amateur sports club. Now, if the estate value is below the threshold, you still have to report this to HMRC. And if you give away your home to your children, and children includes adopted, foster, or stepchildren, or grandchildren, then your threshold can increase by a further 175,000 if the total value of your estate is worth less than 2 million. Otherwise, the resident nil rate band is reduced. Now, when this threshold is exceeded, the resident nil rate band is reduced by £1 for every £2 of value by which an estate exceeds the taper threshold. And tapering can reduce that resident nil rate band down to 0. And if the home is worth less than the maximum resident nil rate band available, then the value of the home is used as that nil rate band amount. The unused portion cannot be used against other assets in the estate, but it can be transferred to the deceased wife, husband, civil partner's estate when they die and leave a home to their direct descendants. This means potentially each individual can have £500,000 available, and this can increase to £1 million per couple because any unused threshold can be added to your partners. Now, the rate of inheritance tax is 40%, and it's charged on the part of your estate above that threshold. So this can reduce to a rate of 36% if you leave 10% or more of the net value of your estate to charity in your will. And an important distinction to make here is that money held in your pension is not included and is therefore considered outside of your estate for inheritance tax purposes. This is one of the reasons why it's important to start planning early, as pensions can be used as a great tool to pass on wealth without incurring an IHT liability. Of course, IHT might change in the future, but this is what it is at the moment. It's been at quite a low level for a while and was increased with the use of the resident nil rate ban a few years ago. So let's look at some examples. So let's say, for example, there's a married couple with children. The estate value is £1 million, including the home. They leave everything to each other in the first instance, and then to their children. In that example, there'll be no IHT liability. Or if there's a single person with no children, and the estate value is £725,000, the nil rate band available is £325,000. There's no resident nil rate band available, even if that person owns the property, because there's no direct descendants, no children to inherit it. Therefore, the inheritance tax charge will be 40% of the £400,000 above the nil rate band, which equals a tax bill of £160,000. Another example is a married couple with children, and their estate value is £2.7 million, including their home. They leave everything to each other in the first instance and then to their children. And in this example, the resident nil rate band is reduced to nil because of the value of the estate above the 2 million. And therefore, the only available nil rate band is 650,000. And then IHT is going to be charged on the amount above that. And so that will be 40% of 2,050,000, which equals a tax bill of 820,000. You can see in different examples, there can be varying amounts of tax liability there or no tax liability. And there are many more nuances to this, so I'd recommend you seek advice for your own individual situation. In this section, we'll start by looking at the process and the probate process and what's involved, who pays the tax and how it's paid, and the importance of drafting a will. When someone dies, it falls to their loved ones to deal with their property, money and possessions, known as their estate. The legal administration of someone's estate is commonly known as probate, and this involves gathering together assets, paying debts and distributing what's left to beneficiaries. If the person who has died has written a will, this document will usually name the executor who is responsible for dealing with the estate. If this is you, then before you can start dealing with the deceased property and money, you need to establish an authority to act as the deceased executor. And to do this, you have to apply for what is known as grant of probate. And if a will hasn't been left, then the next of kin apply for what's known as grant of letters of administration. Probate is required to access most of the assets following death and can take longer than anticipated. It starts with registering the death of the individual with all the relevant parties. Of course, you need to find out if there is a will. Identifying all of the individual's assets, both domestic and foreign, which includes getting valuations as well for properties, investments, jewellery, art, cars, whatever they are. And the valuations will also need to satisfy HMRC. And then you'll need to submit an inheritance tax return and make payments of IHT, usually within 6 months. Paying debts as well, such as mortgages and other items, including funeral expenses and any outstanding taxes. And it's important to note the grant can only be applied once the probate registry has evidence of an IHT received, and therefore they know that the IHT has been paid. The assets can only be collected and distributed in accordance with the will, or with the absence of a will. The intestacy rules apply once the grant has been issued. So until the grant has been issued, the assets cannot be collected and distributed. So it's easy to see how this task can be quite complex, and so it's important to look for help if you need it, and you can get help from a solicitor or probate specialist to help you through that process. Particularly if the estate is complex, or if there are doubts about the validity of a will, or the estate includes foreign assets or property. We'll now look at paying the tax, and for this section, we've got a Q&A with Marie from Freeds. Hello Marie, thank you for joining us today on the topic of inheritance tax planning. So far, I've been covering what inheritance tax is and applying for probate. Now, looking at probate, it's clear that depending on the circumstances and various assets involved, it can be quite a complex task that can take a long time to sort out. And so my next question then is, who pays the tax and how is it paid? Because of course, the assets cannot be collected and distributed until that part's complete.
That's right. The inheritance tax has to be paid before the grant of probate can be obtained. And the executors, if there are executors named in a will, are responsible for that payment. If there isn't a will, then it's the personal representatives, so the people who are dealing with the estate there. Usually the inheritance tax has to be paid in one go, so all of it has to be paid up front. However, if you have a property or properties and in some circumstances shares, the inheritance tax due on those assets can be paid in instalments, and so they're due at sort of 10% every year. The only issue with that is you get charged interest on top of that, and if the asset is sold prior to the 10 years where the final payment's due, then all of the inheritance tax has to be paid at that point. If you have an estate and there are lots of properties and limited amounts of cash, then you've got a slight problem because you might not have access to enough liquid assets in the estate itself before the grant is obtained to deal with those assets to pay the tax. And that's where there can be problems. The executors can, if they've got funds themselves, loan monies to the estate to pay the inheritance tax and then repay themselves when there is enough money in the estate to do that, or they can look to take a loan. They can be quite hard to obtain. So the hope is that people do some planning if they know that there's going to be an inheritance tax liability, just so that there's enough cash there to cover the initial charge.
Yeah, that makes sense. I guess there can be other issues as well then if there isn't enough cash. So if somebody's got a business, or if the money's tied up in some sort of investments that they can't liquidate easily, they might need to find it another way. If they have to pay the bill in one go, is there usually a time limit when they have to pay it?
Yes, the deadline for inheritance tax is 6 months at the end of the month from the date of death. If it's paid after that, it's okay, but interest is charged. If it's not paid within a year of death, then HMRC will impose the interest, but they'll also charge penalties as well. And those penalties will be dependent on the value of money in the estate and down to what has caused the delay. So the tax definitely has to be paid within a year, preferably before 6 months.
Yeah, so ideally fairly quickly as well then.
Yeah.
Okay, and so you mentioned personal representatives of a will. So can we talk a little bit more about the importance of drafting a will and maybe the implications of not having one?
Yes. Quite simply, if you make a will, you're choosing the people to deal with your estate and who benefits from it. If you don't make a will, your estate is subject to the rules of intestacy, and that's where the law says who benefits from your estate. Everyone's situation is different, but if you are in a second relationship, maybe where you've got children from a previous relationship, you should definitely consider having a will to make sure that those children are looked after, if that's what you want. If you're a single person, you would want to think about making a will just to make sure that the people that you want to benefit from your estate do. A lot of the times the rules of intestacy don't really correspond with what people want. And what they want to happen, and so it's better to have a will in place, and especially in terms of tax planning and protecting assets from care fees or a surviving spouse having a future relationship. There are lots of different things that can now be done within wills, as well as the straightforward kind of just making sure that whoever you want to get something does.
Yeah, so it's a really good planning tool to use in advance of somebody passing away. In terms of, you mentioned if somebody doesn't have a will and the rules of intestacy apply, but let's say if they have a will but it isn't quite what the beneficiaries want or intended to happen, is there anything that can be done there?
Yes, you can have what's known as a deed of variation, and that's where the beneficiaries of a will decide that they want to change it, essentially. It has to be done within 2 years of death, and it has to be signed by the person or people who are going to be negatively affected by the change. So, for example, if a will left an asset to grandchildren and those grandchildren were named and then more grandchildren came along, provided that those grandchildren or other people were over 18 and could consent to the change, they could agree that the new grandchildren could benefit from the estate. So there is tax planning that can be done, and other forms of planning and changing the will after death, but that's in place at the moment. There are rumours that the law may change with regards to that, so it's important to not rely on that provision too much, just in case things do change in future.
Okay, brilliant. Thank you, Marie. That's been really interesting and helpful. I'm going to take it from here now and look at ways in which somebody can reduce the value of their estate. And I'll speak to you again on the topic of trusts, if that's okay.
Yeah, lovely. Speak to you soon.
Speak to you soon.
So that was a quick sort of run through of planning with wills, probate, and why they're important, and what you can do afterwards. So in summary, the important things are to sort out a will as soon as possible if you don't have one. Keep it up to date if you do have one, there are always circumstances in life that can change things, such as marriage, divorce, children. It also helps to avoid intestacy, so you can make sure the people that you want to benefit from your estate will do so. And will planning can be a useful tool for inheritance tax planning. You can also use things like deed of variation afterwards, even so once your will has been written, that can be utilised within 2 years of death, and in particular for circumstances where, for example, the will isn't written in the most tax efficient way, or if the deceased has not updated their will and inadvertently left somebody out, if the distribution is not equal between beneficiaries, or if no will has been written, or to clear up any uncertainties within the will. But of course, planning in advance is much better and easier to deal with than trying to sort things out often after the fact. So, as I mentioned at the end of the video there, we'll now look at some of the practical considerations involved when planning for estate planning and what steps you can take to try and minimise any inheritance tax liability you might have. And inheritance tax is called a voluntary tax because with effective and timely planning, the tax charge can be reduced or even eliminated entirely. But before we move on to this section, there are some possible changes on the horizon. The Office for Tax Simplification has undertaken a review into ways in which they can simplify inheritance tax. And some of the proposed changes are things like replacing certain gift exemptions with an overall personal gifts allowance, so making that more simplified, reviewing the level of the exemptions, reforming the normal expenditure out of income exemption, which we'll look at as well, reducing the 7-year period. You may have heard of there's a 7-year period or a 7-year plot that applies with inheritance tax planning. Again, we'll look at this in a bit more detail as we go along, but they've made a suggestion to perhaps reduce that to 5 years and abolishing the taper relief that applies within the 7-year period. And again, we'll look at that as well. And there are possible changes to other things, such as a relief known as business property relief, and considering some changes around there. So these are all proposals they've made. Whether they come into effect or not, we don't know yet, but it's something just to be mindful of and keep an eye on. As I say, legislation and things change, which is why it's important to keep things under review. So let's look at some effective ways in which financial planning can help reduce the value of your estate. Well, first of all, you have certain exemptions. So gifts, there are certain gifts that may be immediately exempt or just not regarded as transfers at all. So for example, transfers during lifetime and death transfers between spouses or civil partners are not considered a transfer for inheritance tax purposes at all, and they're immediately outside of the issues there. Payments can also be made by a parent towards their child's maintenance or education. So if you have young children, then that's quite perfectly valid, and that's not regarded as a transfer of value, and therefore it's free from inheritance tax. Now the child must be under 18 for that or in full-time education to qualify. And that treatment does not apply to similar payments from grandparents. They would normally be treated as gifts, and therefore they may be some inheritance tax issues there. But there's a bit more on that later. Also, there's normal expenditure out of income, and that's another good exemption that's available, because you can make regular gifts which are made out of surplus income that you can do, which do not affect your usual standard of living. And that's immediately outside of your estate for inheritance tax. So that can be quite a useful one. So if you find that you have a surplus income at the end of every year, you're not spending, and you've already got an inheritance tax problem, well, rather than accumulating that and making your own inheritance tax situation worse, you may consider making gifts of that excess amount. There are also annual exemptions, so you can make a gift of up to £3,000 each year, which can be gifted free of inheritance tax. And if the previous year allowance hasn't been used, then that can be carried forward 1 year to make it £6,000. And again, that's per individual. Also, small gifts. So any number of small gifts of up to £250 can be gifted each year. And gifts in consideration of marriage. So each parent may gift up to £5,000 in consideration of marriage or civil partnership. And for grandparents making that gift, the figure is £2,500. So while some of them might not sound like they're going to make a big impact on reducing inheritance tax liabilities, you can easily see that combining some of these and taking advantage of them while they're there all adds up, and it all makes a difference over time. I mentioned earlier business property relief. So before we look at some of the gifting strategies in a bit more detail, there are other reliefs available, such as business property relief, and this provides relief from inheritance tax on a transfer of relevant business assets, either at a rate of 50% or 100%. Now, relevant business property consists of things like a business, an interest in a business, or a controlling interest in unquoted shares. This is including AIM shares or unlisted shares, so private company shares. There are some circumstances when you cannot claim business property relief. So that's for things like when you've got a company that deals mainly with securities or stocks and shares or lands and buildings, or is making or holding investments, or if it's a non-profit organisation. So if you have a charity, then that's not business property relief doesn't apply. So there are other scenarios there as well. And also, you can't claim business relief on an asset if it qualifies for agricultural relief, which is another relief available, and that is again available at a rate of 50 or 100%. But we're not going to go into too much about that today. Agricultural property covers things like land and pasture that's used for crops and rearing animals, so that's particular to sort of the farming sector, if you like. And that's quite a specific relief. So if you think that does apply, then of course speak to a professional to understand that further and how that might be a benefit to you. But there are situations where you can get a relief for 50%. So if you have shares controlling more than 50% of the voting rights in a listed company, for example, then you can get 50% relief there. And any relevant property, so when you looked at the definition of relevant property, it must be held for at least 2 years in order to qualify for relief. So there are some strategies there that you can take advantage of, and you don't have to use the 7-year clock. You've got a 2-year clock to qualify, but you have to understand whether that applies or not. So it's important to seek professional advice there. So let's look at some of the other practical areas around gifting and making gifting strategies and what you can do there to take advantage of inheritance tax planning. But what you can do is you can make outright gifts. So whether a parent or grandparent makes any of the lifetime gifts beyond any of the exempted gifts that we looked at earlier, they're typically classed as what's known as a potentially exempt transfer or a chargeable lifetime transfer. So we call that either a PET or a CLT. And the gifted amount is usually outside of the estate should you survive for 7 years from the date of gift. So there are many reasons why parents or grandparents want to make gifts for their children or grandchildren, even where there's no IHT issues. So it may be to help meet the cost of school fees or paying off student debt or helping them on the property ladder. But usually the prime motive is often to reduce the value of your own estate for IHT purposes. And the reason for gifting can have a huge bearing on how investments are held and the choice of the investment wrapper, and also the age and tax position of beneficiaries should be considered as well during the investment period and the date the funds are needed. All of those things help to determine the choices made. So with outright gifts, making an outright gift to a child or grandchild is probably the simplest way of gifting. It's effective where money is needed for an immediate rather than a future purpose. However, the age of the child will need to be considered, and you have to ask yourself, are they old enough to hold the money or investments in their own name? And do they have the financial maturity to use it for the purpose for which it's intended? And if the answer to those questions is no, then it may be that a gift is not made until such time as the beneficiary needs the money for a particular purpose, such as university costs, for example. The grandparents or parents may wish to save for these events in advance, and holding investments in their own name while earmarking them for their children or grandchildren. This approach also keeps planning flexible, should you change your mind for any reason, or in case you need the funds in an emergency or for another purpose. Of course, that's not quite as effective for inheritance tax planning, if that's your priority, and usually the tax status of the grandparent or parent will also influence the choices made there. Junior ISAs is another effective way of taking advantage of some planning, because parents and grandparents can make an annual contribution to junior ISAs, and the subscription limit currently is £9,000 per person. So that allows a pot of savings which are free from income tax and capital gains tax to be accumulated for the child or grandchild. And as junior ISAs do not pay tax on income, there's something known as the parental settlement rules, which we'll look at. They don't apply either. And if the annual subscription is paid each year from surplus income, then the gifts may be outside of your estate immediately for inheritance tax. We looked at before with gifts out of normal income. Third-party pension contributions are quite an effective planning tool as well, because they can be made into a child or grandchild's pension. Of course, the only downside, the biggest downside, is the child cannot access the money until minimum pension age, which is currently 55 and rising possibly to 57 and beyond by the time they get there. And if the child has no earnings, then you're limited to how much you can put in to the pension. The contributions there in that example are limited to £2,880 a year currently, but they are grossed up. So HMRC do add some tax relief in there, £720, taking it up to £3,600 in the pension. So that's useful as well, because you get a bit of tax relief on the way in. And higher contributions can be made if the child's old enough and has earned income. Contribution limits and tax relief are based upon, obviously, the child's tax position. So paying contribution into an adult child pension can be quite useful because it helps to free up their own income, which can be used for other things. So that can be quite useful for younger families to help save if they want to, you want to help them save for a deposit, or for their own mortgage payments, or childcare, or education. And as they are likely to have earnings themselves, their higher amounts are available to put into the pension, subject to certain limits, of course, such as the annual allowance. The gift to a child's pension, whether they're a minor or adult, will be a potentially exempt transfer for IHT. So that's what we call the PET, where the 7-year clock starts ticking, if this isn't a gift that's made out of your surplus income. There is an important tip here, that if the adult child is in receipt of a gift into their pension, then before they reduce their own pension funding, they need to make sure they're not missing out on any employer pension contributions by doing so. So if their employer are paying contributions in as well, they may be missing out if they decide to reduce what they pay in because the parent or grandparent is helping to fund their pension for them. I mentioned parental settlements, and this is a particular rule where if parents make gifts for their minor children, which they may continue to be assessable for income, which arises from the gift, or if that income exceeds £100 each year, then the whole amount is taxed as the parent's income. And that limit is per parent, per child. And the rules apply where the child is absolutely entitled to the income. For example, if the money was simply paid by the parents into a children's deposit account, or the child's entitlement is under an absolute or trust set up, or some kind of trust that was set up by the parents. However, if the parent creates a discretionary trust, and again we'll look at trusts in a bit more detail as we go along, if their parent creates a discretionary trust where the child has no right to income, then the parental settlement rule only applies if income is actually paid or it's paid out for the benefit of the child. And those rules do not apply where grandparents make a gift for a minor grandchild, and do not apply to junior ISAs, don't forget, because ISAs do not pay tax on income. So again, it's important just to make sure that you're not falling foul of any tax implications when making gifts, and depending on how you're making the gifts, where you're making them to, how old the beneficiary is, and so on. Now, we mentioned pets and potentially exempt transfers, so let's cover this in a bit more detail. When we talk about pets, we don't mean the fluffy companions that we all know and love. Simply put, pets are applied to lifetime gifts to individuals, and when made, they don't create an immediate IHT tax charge, and instead it starts a 7-year clock, and as long as you survive 7 years from the date of gift, the value of the gift will fall outside of your estate for inheritance tax entirely. And even if you don't survive 7 years, but you survive more than 3 years, or something called taper relief applies, which still helps to reduce your IHT liability. And that taper relief reduces from year 3 onwards to year 7, and after year 7, there's no inheritance tax at 0. But if the gift, it's important to remember, if the gift is brought back into your estate, because inheritance tax is due, and you brought the gift back in, then it is valued at the date the gift was made, not at the date of death. And that's quite an important distinction to make, because the value in which you make the gift might be will obviously be before the date of death. And if that gift has gone up in value, it's actually based on the amount when you made the gift, not what it was at the time of death. So it might be worth more at the time of death, depending on what was gifted, for example, if it was in some sort of investment plan. So even before coronavirus, this was one of the most common ways to reduce the value of the estate, by making gifts and starting a 7-year clock ticking, and it still remains one of the most effective ways to do so now. There are other things to consider, of course. For example, depending on the assets you gift, there may be things like capital gains tax to consider if you're disposing of an asset to gift it away. And this is where the asset itself will form the gift, or the cash proceeds will be the gift. CGT doesn't apply if it's a gift of cash, of course, because if you already hold cash in the bank, then there isn't a gain on the cash there to pay. But for example, if it's a property, maybe a rental property that you own, and you want to sell it and gift it, well, you might have a capital gains tax liability on the gain that you've made before you can gift it. And gifts of any value can be made. And it's often that gifts up to an individual's nil rate band, the threshold of 325,000, which we looked at earlier, are made, or for joint couples, 650,000. And the reason for that is because gifts made in excess of the threshold, so of course you can gift in excess of the threshold, carry a lifetime inheritance tax charge immediately of 20%. And they're what's known as a chargeable lifetime transfer, and it has a chargeable lifetime transfer tax. So it's important to also remember that where there have been pets within 7 years of death and the tax is due on death, it's the recipient of the pet who is liable for the tax in that example. So if you made a gift to somebody, for example, a child or one of your children, and the tax is due on the death, and it's within 7 years you passed away of making a gift, well, it's that recipient of the gift who's liable for the tax. Gifts can also be made into trusts, and we'll look at trusts in a moment. And larger estates may consider using things like family investment companies as an alternative to trusts. And again, we'll look at that in a little bit of detail because they don't carry a lifetime inheritance tax charge. And gifts are often made into trusts because they can allow an element of control, which is often an attractive feature of making gifts, particularly if there are younger people that you want to gift the money to that you may not want to have access to the money straight away. So let's reach out to Marie again and explore trusts in a little bit more detail.
Hello again, Marie. Since we last spoke, I've been looking at various ways in which people can reduce the value of their estate, including exemptions, reliefs and gifting strategies. And I've been touching on the topic of pets, potentially exempt transfers, and the 7-year rule. And I was saying that gifts up to an individual or couple's nil rate band are often made into trusts, because trusts have some added features that can be quite appealing. So what type of trusts are commonly used, and when might somebody consider using one?
Trusts that are set up in lifetimes tend to be discretionary trusts, and that's where somebody decides that they want to get rid of an asset, they don't need it themselves, but they want to retain some control over it and who it's directed to. And so they set up a discretionary trust. They tend to also be a trustee, so they're in charge of who benefits from that asset and when. And then it's down to them to decide, along with any other trustees, who benefits from the asset and at what point. And there's usually a letter of wishes that's put into place as well, so that if anything happens to the trustee, then their thoughts in how they'd want the trust to be administered can continue, and so the trustees who do take over the running of the trust can fulfil those wishes. There are also bare trusts, and they're the most basic kind of trust, and the most straightforward one that there is. That's where you would give an asset to somebody and they would simply look after it for somebody else. It would be down to them to decide as and when who benefited from that. There are also trusts that can be put into wills, which are slightly different in terms of what they do, as they only come into effect on death. But as well as discretionary trusts appearing in wills, you also see a lot of lifetime trust, life interest trusts, and that's where people want to, usually spouses, married couples, want to make sure that their property is protected for future generations, but also allowing their spouse to have a right to income from it, or a right to live in a property if it were a house, for example.
Okay, that sounds quite interesting. So I guess with the discretionary trust, there are some advantages in that there's some flexibility for beneficiaries, and it can be used for various different beneficiaries. And the bare trust is a little bit more straightforward in that the beneficiaries are named at the outset and who's going to get what. Would you say there are any disadvantages or any things to consider? I know there are some particular tax quirks between both types of trusts.
In terms of discretionary trust, depending on the value of the assets going in, there could be exit charges, and that's a charge when anything goes out of the trust. There could be entry charges depending on the value of the assets going into the trust, and 10 yearly charges. Again, those values would be dependent on the value of the assets going in and the value of the assets at the date of them exiting the trust, or the 10-year anniversary charges. But the charge itself is quite low. It's a maximum of 6% of the value of the asset at the time. The good thing about the trust is that as soon as you give the asset away and it goes into the trust, the 7-year clock starts running. And if you survive 7 years from the date of making the gift, then that asset's out of your own estate for inheritance tax purposes, and so could lead to a substantial tax saving.
Yeah.
In terms of bare trust, again, the 7-year clock would start running as soon as you gave that asset away, but you wouldn't have the annual charges, the 10-year charges or the exit charges, but you then wouldn't have a lot of control. You'd lose that element.
Yeah, that's the downside, I guess, with that trust. So I think what we see is, in most cases, people that want to use trust tend to gift up to or as close to their nil rate band threshold, so that they don't have any of the sort of entry charges and so on, and potential charges along the way. Are there any planning opportunities for those that want to gift more than that? I know that there are some things like family investment companies that can be used.
Yes, family investment companies are a vehicle where they're also a form of trust, but they incorporate a lot of corporate elements. You tend to have a company that's set up to deal with the assets in the trust, and that company issues shares, and those shares are then held in different classes, and you'd have a different class of share passing to a different sort of beneficiary. So the owners of the company would have a different right to the assets in the trust as opposed to the beneficiaries, who might be children, grandchildren.
Okay, so I suppose one disadvantage of trusts or family investment company type solutions may be that professional costs may make the trusts sort of uneconomic, if you like. Would you say there's any sort of de facto minimum amount that people should be considering for use of trust to make it cost effective?
As you said, to make it cost effective, I'd suggest going as high as you can to the nil rate band, essentially, because then you're getting rid of as much money as possible without there being an immediate charge to tax. And then the costs of administering the trust are then sort of, the value is a lot better.
Yeah.
In terms of professional costs as well, you don't have to have a professional trustee with the trusts at all. You could just have family members if you were confident in doing that. You would probably want somebody to assist with the tax calculation, so there would be maybe accountants' fees on top. But depending on what work was actually done, the professional fees could be quite low.
Yeah, so it doesn't have to be so uneconomic or so complex as people might think.
Right.
That's really good. Okay, well, thank you, Marie, for that valuable insight. It's been really helpful and useful. I'm going to look at now what somebody can do if they've done all their planning and there's nothing else that they can really do and there's still a liability. So what other options do they have? So I'm going to take it from here, and then we'll speak to you again next time.
Lovely.
Okay, so that's the input from Marie around trusts and the use of trusts for inheritance tax planning. Now, the summary here is that, of course, making gifts into trust can allow trustees to appoint money to beneficiaries at appropriate time when they feel it's relevant. It prevents the child from being able to get access to the capital straight away. It allows gifts to be made for minor children and provides additional control. And that may help to alleviate concerns about giving young people access to too much too soon. Bare trusts are one of the most simplest form of trust. The beneficiaries are, they're just named at the outset, but that cannot be changed, and future children or grandchildren cannot be added once the trust is set up. So that's a downside. But the beneficiary also has the right to both capital in the trust and any income generated from it. And they'll be taxed on any income and gains, unless, of course, the parental settlement rules apply. And the trustees, the trust can continue beyond 18 as well in that case, so they don't have to pay it out all at once at 18, it can continue. However, the trustees do need to notify the beneficiary and pass on the details of income and gains generated, so the beneficiary can declare them on their own tax return. And then if the beneficiary does demand the trust property once they are 18, the trustees must pay it to them. So there are some of the downsides with bare trusts. Discretionary trusts are a little bit more common because they allow the greatest flexibility, and the trustees have complete discretion over the payment of both capital and income, and that allows the trustees to pay out at the appropriate time if funds are needed for a particular purpose, or they can wait until they feel the beneficiaries are old enough to look after the money themselves. And beneficiaries are often described by a class, so they're not always individually named. So they're defined by a class such as the children or grandchildren of the settler. So that means if there are future children or grandchildren born after the trust was created, they're still accounted for and able to benefit from the trust. There are also other trusts that can be utilised, such as a discretionary a discounted gift trust, which allows the settler, the person making the gift, to retain a right to a fixed level of income, which is usually up to 5% of the original investment each year. and that continues for life or until the trust fund runs out if they live long enough. There's also something known as a flexible reversionary trust, which is a discretionary trust with an annual reversion for the settler, the person making the gift, with the trustee's approval, of course. And then the settler can decide each year if they want access to some capital or not at the plan anniversary. So if they don't need something back from the trust for their own use, it can again just continue. But all that flexibility, as you say, comes at a price. From an IHT perspective, gifts into trusts are considered a potentially exempt transfer and chargeable lifetime transfer. And if it's greater than the available nil rate band, they do incur a tax charge on the way in. And of course, the 7-year clock needs to be considered as well. And as Marie mentioned, there may also be periodic and exit charges depending on the value of the trust. And then trustees may also have other taxes to pay, such as income, dividend, or capital gains tax. So that's something to keep in mind. So tax implications and differences of trust and remembering parental settlements can be quite complex, but it's important to make sure that you do just take professional advice if you're looking at setting up a trust and making sure that you're getting the right trust for the right purpose. And so, as we mentioned at the end of the video, let's say you've looked at all the planning, you've taken advantage of the exemptions that are available, the reliefs that are available, you've started some gifting strategies, started the 7-year clock ticking and so on, but you still have a liability, and what are your options there? And so, of course, because whatever liability you have, it's a 40% charge for the above the amount above the threshold. There are ways in which you can mitigate against that. And one of the, again, simplest ways of doing so is insuring against the liability. So taking out a life insurance policy to pay some or all of the inheritance tax bill can make things easier on your family when it comes to sorting out your estate after death. It can help protect your home and other assets from having to be sold to pay an inheritance tax bill, which, as we mentioned, usually has to be paid before probate is granted. And if it's paid in instalments or paid longer, there can be penalties or interest applied as well. So it gives you peace of mind knowing that your family and other beneficiaries are not having to pay a potentially large tax bill when you pass away. And most life insurance policies will count as part of the estate unless the policy itself is written into trust. But that can often be done at no extra cost when taking out your policy. So this means that any money that's paid out to your beneficiaries doesn't form part of your estate, and the payout doesn't count towards your threshold, and it's not subject to inheritance tax. So it avoids the lengthy probate process, and so your beneficiaries will get access to the capital much more quickly. A whole of life insurance policy is often the insurance policy that's used in these circumstances, and that remains in force until the policyholder whose life it's covering has passed away, provided you continue to pay the premiums. They can be quite cost effective. You often find that you won't have paid in as much as you get paid out, and so it can be quite a valuable tool against the inheritance tax liability. As I said, the policy lasts as long as you live and pays out when you die, and make sure you keep your premiums up to date. But you do have to bear in mind that you could be paying premiums well into your 80s or 90s or beyond, and premiums become more expensive the older you get. And they can increase over time as well if you have increasing premiums, but you can have fixed premiums as well, so you know exactly what you're going to pay at the outset. And again, don't forget, the older you get, it can be more difficult to get insured as you get older and you start to have health problems. So again, it's something to look at early on in the process to see, when you look at your planning, taking advantage of all the areas that you can, starting at things at the most flexible, the lowest cost, and so on. And then if you need some insurance, you can insure against the liability But again, don't put that off and think, okay, you'll get to that eventually, because you may not be able to get cover if you leave it too long. So by now, hopefully you should have a bit of a better understanding of what inheritance tax is, when it's payable, by who, and the process involved. Hopefully you understand the importance of wills and the importance of estate planning. Of course, the younger you start the planning, the better. Don't leave this at the back of your to-do list. Experience tells us that often that can then limit the options available to you as you get older. And IHT planning is in itself a specialist subject, so there are other reliefs and exemptions and tax planning considerations that we've not gone into too much detail today because they're beyond the scope of the webinar, otherwise it just becomes too technical and too broad. And they do very much depend on your own individual circumstances. The important thing to know, there's plenty of opportunity to be able to pass on a lot of your wealth to children and grandchildren, family and other beneficiaries that you may have in mind before IHT becomes an issue. But keep in mind, though, by not doing so means that you're going to be part of the group that ends up paying. And HMRC collected £5.2 billion in inheritance tax last year. So it might not sound like a lot if per individual household, but they are collecting a large tax receipt. And as I say, if that's your intention to add to that pot, then that's absolutely fine as well. But if you want to protect your assets and your value for your beneficiaries and your family, then there are planning opportunities. I think the main takeaway is you shouldn't worry about inheritance tax. Seek advice if you think you have a tax liability or if you're not sure. And if you want to protect the value of your estate, that of course you've worked hard to build up throughout your life, there are opportunities available to do so. And it's equally as important to keep your estate planning strategy under regular review, because circumstances, as we've seen recently, can change dramatically and quickly, just from this pandemic this year alone. So if you'd like to know more, please do get in touch with us. I've seen a couple of questions pop up, so I'll look at those in a moment. So if you'd like to know more, get in contact with us. We offer a friendly, no obligation, no cost meeting to discuss your circumstances further. And if we can help, we will. If you need legal support, you can reach out to Marie at Fries. I'll pop her details and more details on the final slide here. And I'll look at some questions. If you think of any questions afterwards, again, feel free just to get in contact, either send an email, give us a call. If you have an advisor here already with us, just pick up the phone to them and we'll be happy to help.